Startups are the engines of innovation, driving economic growth and creating jobs. However, securing funding is often a significant hurdle, especially in challenging economic times. India's startup ecosystem, while vibrant, is currently facing a liquidity crunch. Traditional avenues of fundraising, such as bank loans, often come with stringent requirements that many startups struggle to meet. This is where venture debt emerges as a beacon of hope, offering a lifeline to startups seeking capital without relinquishing precious equity. Venture debt has witnessed a surge in popularity in recent years, becoming an increasingly viable financing option for startups across various sectors. This alternative funding model provides a much-needed solution for companies seeking to fuel their growth without significantly diluting their ownership. As the Indian startup ecosystem navigates the complexities of a dynamic market, venture debt presents a flexible and strategic funding avenue. Venture debt's rise in popularity is intrinsically linked to the challenges startups encounter when seeking traditional funding. Banks often hesitate to lend to young companies without a proven track record or substantial collateral. Equity financing, while a viable option, can lead to significant dilution of ownership, a concern for many founders. Venture debt addresses these pain points by offering a debt instrument specifically designed for the unique needs and circumstances of startups. In essence, venture debt acts as a bridge, providing startups with the capital needed to navigate the often turbulent waters of the business world. It empowers them to scale their operations, invest in product development, and expand their market reach without sacrificing control over their ventures. Venture debt is a form of debt financing tailored specifically for high-growth, venture-backed companies. Unlike traditional bank loans, venture debt providers are more lenient with collateral requirements, recognizing that startups often lack tangible assets in their early stages. Instead, these lenders focus on the growth potential and future prospects of the business, particularly if the startup has already secured equity financing, which acts as a signal of investor confidence. One of the most attractive features of venture debt is that it does not dilute the equity of the founders and existing investors. This is crucial for startups, as equity represents ownership and control of the company. By opting for venture debt, entrepreneurs can retain a larger stake in their ventures while accessing the capital needed to fuel growth. Venture debt operates on a fixed repayment schedule, typically with a moratorium period during which only interest payments are required. This structure allows startups to conserve cash flow in the crucial early years of operation, focusing resources on scaling the business and achieving profitability. Venture debt is not a one-size-fits-all solution. It is typically offered in conjunction with equity financing, acting as a complementary funding source. The terms of a venture debt agreement, including the loan amount, interest rate, and repayment schedule, are negotiated based on the specific circumstances and requirements of the startup. The Indian venture debt ecosystem is supported by a range of key players, each contributing to the growth and sustainability of startups across the nation. These players include specialized venture debt firms, banks with dedicated venture lending arms, and alternative financing platforms. Each entity brings unique expertise and resources to the table, helping startups navigate the complexities of securing non-dilutive capital. Specialized venture debt firms are at the forefront, offering tailored financing solutions that align with the unique needs of high-growth startups. These firms often have deep industry knowledge and can provide strategic guidance alongside capital. Banks with dedicated venture lending arms play a crucial role as well. They leverage their extensive financial infrastructure to provide startups with access to capital, often under more favorable terms than traditional bank loans. Alternative financing platforms are also emerging as significant players in the ecosystem. These platforms leverage technology to connect startups with a broader range of debt financing options, increasing accessibility and convenience. Together, these key players are instrumental in bridging the funding gap for startups in India, ensuring that innovative companies have the necessary resources to thrive and contribute to the economy. Section 4: Success Stories, Startups Thriving with Venture Debt. Section 5: Balancing the equation, venture debt and equity financing.